Welcome back to the deep dive. Usually when we crack open a corporate annual report, a Form 10K, you expect a certain level of, well, dryness,
A lot of jargon for sure.
right? Jargon, tables, maybe a generic letter about synergies. But today,
hmm
today we are looking at something that feels less like a financial report and, I don't know, more like a manifesto for a sci-fi revolution.
With a balance sheet stapled to the back.
Exactly.
It really is a unique document. We're sitting here, it's early 2026, and we're looking back at Tesla's fiscal year 2025. And if you just skim the surface, it looks like a car company having a pretty rough year.
Mm.
But if you actually read the narrative, Tesla is explicitly telling us, stop thinking of us as a car manufacturer. They are positioning themselves in black and white legal text as an AI and robotics company.
That is the part that just blew my mind. I mean, we've seen the posts on X, we've heard the rumors, but seeing it in an SEC filing it hits different. It's legally binding. But here's the tension I really want to explore today. We have a company where the core business selling cars is actually shrinking. Revenues are down. Profits are down.
Way down.
And yet, they are hoarding cash like they're preparing for something huge, and they're betting almost all of it on things that don't really exist at scale yet. We're talking robotaxis and humanoid robots.
It's a massive, massive pivot, and they're doing it while navigating a political minefield that completely shifted under their feet last year.
Oh, we are definitely going to get into the OBBBA legislation. I still can't believe that acronym stuck.
I know.
But before we get to the politics and the robots, we have to eat our vegetables. We have to look at the money. Because if I'm an investor looking at the top line numbers for 2025, I'm not seeing a growth story. I'm seeing shrinkage.
You're not wrong. Let's look at what we can call the ouch numbers. Total revenues for 2025, they dropped to $94.8 billion.
Okay, which is down from what?
Down from $97.7 billion in 2024. For a company that was priced for, hyper-growth for a decade, seeing the revenue line actually go backward is a real shock to the system.
And the profit picture was even uglier, right? I saw the net income number and did a double take.
It was a significant drop. Net income plummeted to $3.79 billion.
Wow.
To put that in perspective, the previous year it was $7.09 billion.
So that's nearly a 50% drop in 1 year.
Yeah. Nearly half the profitability year over year.
Okay, pause. A 50% drop, that's massive. What on earth caused that? Did people just stop buying electric cars?
It's a combination of volume and price. Automotive sales specifically dropped to 9%.
Okay.
The filing says this is from an 8% decrease in vehicle deliveries, but also, and this is crucial, lower average selling prices. You have to remember the context of 2025. High interest rates were still crushing consumers.
Right, because when interest rates are high,
Right.
your monthly payment goes way up, so you either don't buy a car or you buy a much cheaper one.
Exactly. So they sold fewer cars and they sold them for less money. That just crushes your margins.
Okay, so that's the bad news. But here's the paradox that I need you to explain to me, because it sounds like accounting magic. Despite making way less profit, literally half the profit of the year before, they somehow have more cash in the bank than they did a year ago.
That is the number that really matters here. Cash and investments ended 2025 at $44.06 billion. That's up $7.5 billion from the year before.
Make it make sense. How do you lose profit but gain cash?
This is a classic deep dive moment where we have to distinguish between net income and cash flow. Net income includes a lot of non-cash expenses. The biggest one for Tesla is depreciation and stock-based compensation.
Explain that like I'm 5.
Okay, so imagine you buy a factory for $1 billion. You spend that cash on day one. But on your profit statement, you don't record that whole billion as a loss right away.
Right.
You depreciate it over, say, 20 years. So every year, you record a loss on paper for the wear and tear of the factory, but no actual cash is leaving your bank account that year.
So their paper profit looks low because they're writing off the value of their factories and paying people in stock, but the actual cash register is still ringing.
Precisely. They're extremely efficient at generating operating cash flow. But the really interesting question isn't how they have the cash, it's why they're keeping it. Why sit on $44 billion?
Usually a company would use that to buy back stock or pay a dividend or something, right? To make shareholders happy?
Usually. But Tesla is building a fortress balance sheet because they are preparing for a massive capital expenditure cycle. They project spending over $20 billion in 2026 alone.
$20 billion
It's
in
awful.
1 year. And I'm guessing they aren't spending that on just building more car factories to build more Model Ys.
No. And this is where the pivot happens. A huge chunk of that is earmarked for AI infrastructure, compute power, data centers. They're saving their acorns because they are about to plant a very, very expensive forest.
Which brings us to the science fiction part of the filing. They aren't just hinting at AI, they're screaming it. I think the quote was, "We are focused on bringing artificial intelligence into the real world."
That's the core identity shift. For years, the debate was, is it a car company or a tech company? This report is Tesla explicitly stating, we are an AI company.
And the mascots for this new identity are Optimus, the humanoid robot, and the cybercab. Now, we actually saw the Robotaxi service launch back in June 2025. I remember the headlines.
We did, but the filing makes a really important distinction. The service that launched in June uses the Model Y.
Okay.
It's an autonomous ride-hailing platform, but it's running on the existing vehicle. It still has a steering wheel.
Right. But the end game is the cybercab.
Correct. The plan, according to this filing, is to transition the service to the purpose-built cybercab. No steering wheel, no pedals, totally optimized for cost per mile.
It sounds incredible, but I have to play devil's advocate here. I'm reading the risk factors section, which you know I love.
Hey, me too.
And it seems like even Tesla is a little nervous about whether people will actually, use this thing.
You spotted that. It's a very specific risk factor. The filing warns that the adoption of autonomous driving solutions might not happen as fast as they hope. They're banking everything on a service-driven business model based on fleet profits.
Which means they want to stop making money on the hardware sale and start making money on the ride fee.
Exactly.
But if the public is scared of robots, or if regulators, which we'll get to, don't approve it, that business model just hits a brick wall.
It's a behavioral risk, not just a technical one. The tech might work perfectly, but if you don't feel safe putting your kid in a car with no driver, the revenue is zero.
And yet they are doubling down on the hardware to make it happen. The report talks about the Cortex training cluster at Gigafactory, Texas. This isn't just a server room. It sounds like a beast.
It is a supercomputer cluster on a massive scale. And they mention a collaboration with Samsung for specific AI semiconductors. This is crucial because it shows they aren't just buying NVIDIA chips off the shelf like everyone else.
They're designing their own.
They are designing their own architecture. And they threw some money at XAI in January 2026, too. It's vertical integration, but for intelligence. They want to own the compute, the training data, the robot, and the taxi service.
It's incredibly ambitious. But here's the thing that surprised me. While the car business is taking a nap and the robots are still basically a science experiment, there's one part of the company that's actually making money hand over fist right now.
And nobody talks about it?
Nobody. You're talking about the energy sector.
Yes. The unsung hero.
I looked at the margins and my jaw dropped.
It really is the standout metric of 2025. While automotive revenue was down, energy generation and storage revenue was up 27%, hitting $12.8 billion.
But the real story is the profitability.
Oh yeah, the gross margin for energy is nearly 30%. That is almost double the automotive margin, which is sitting at, what, 17.8%?
Historically, auto margins were the gold standard at Tesla. When did the battery business become the cash cow?
It's a combination of scaling up production, specifically the Megapack, and a huge shift in the global market. The filing mentions Megapack 3 and this Mega Block architecture, which cuts down installation costs. But the demand driver is fascinating.
Let me guess. It's not people putting solar panels on their roofs.
No, I mean, Powerwall is still a thing, but the real driver is connected to what we were just talking about, AI.
Wait, how does AI drive battery sales?
Well, think about what AI needs. It needs data centers, massive ones.
Okay.
And those data centers consume an ungodly amount of electricity. The grid is struggling to keep up with this rapid load growth, as the filing calls it.
So if you're building a huge data center for AI, you need a massive battery backup just to ensure you have stable power.
Exactly. Or to smooth out the load so you don't crash the local grid. Tesla's energy division is selling the shovels during the AI gold rush. The AI boom creates a power problem, and Tesla sells the solution.
That is some serious synergy. They create demand with their own AI and then sell the solution to everyone else doing the same thing.
It provides a very stable, high-margin cash flow while they try to figure out the whole robotaxi thing. It's effectively subsidizing the transition.
But, and there's always a but, we have to talk about the external forces. We mentioned the political minefield earlier. Let's talk about the OBBBA.
The One Big Beautiful Bill Act, enacted July 4th, 2025.
Very subtle naming convention there.
Very. And this legislation just fundamentally changed the playing field for Tesla and the entire U.S. auto industry. It repealed many of the tax credits from the Inflation Reduction Act, the IRA, that have been fueling EV demand.
So that $7,500 tax credit that everyone was using to buy a Model Y,
Gone, vaporized overnight.
well, that explains the demand drop right there. If a car suddenly costs $7,500 more, fewer people are going to buy it.
But it's not just the consumer side. The OBBBA also hit Tesla's corporate tax bill. Their effective tax rate jumped from 20% to 27%.
Ouch. So the government rug pulled the consumer incentives and then hiked the taxes on the company.
Correct. The filing is quite impartial but direct. It notes that these policy changes created unfavorable conditions for demand. But there's another layer here. Tariffs.
Specifically on China, right?
That's heightened import tariffs. Now, Tesla makes cars in China, but they also source components from China for their U.S. factories. If you need a specific widget that only comes from China, that widget just got much, much more expensive.
Which explains the scramble to build everything in-house. I saw the report mention they opened their own lithium refinery in Texas in January 2026.
That is the strategic response. It's called localization. If you refine the lithium in Texas, you don't pay an import tariff on it. They are trying to insulate themselves from the trade war by owning the entire supply chain right down to the dirt.
It's really a game of 4D chess. You have to predict the tech, the consumer, and the political wins. Speaking of people, let's look at the human capital section.
Tesla is now employing 134,785 people worldwide.
That is a small city.
It is, and the filing notes the labor market for AI talent is extremely competitive. They are fighting Google, Meta, OpenAI for the same people, but the most interesting human capital story is, of course, the boss.
Elon. I was reading about the 2025 CEO Performance Award. It sounds incredibly complicated. How does he actually get paid?
It is complex. It's a grant with 12 tranches.
Okay, tranches is a fancy finance word. Break it down.
Think of it like a video game with 12 levels. To unlock a level and get the stock options that come with it, he has to beat two bosses at the same time.
Two bosses.
Yes. Boss number one is market capitalization. The stock price has to hit a certain target. Boss number two is operational. He has to hit a target for revenue or EBITDA. He has to beat both to unlock the tranche.
So he can't just tweet the stock price up. He has to actually build a business that makes money.
Theoretically, yes. But here is where the filing includes a very specific and, frankly, kind of provocative risk factor. It warns of misalignment.
Misalignment.
The fear is that the CEO might be incentivized to chase product goals, like flashy robots or AI breakthroughs that pump the stock price, hitting that market cap target, but don't necessarily generate immediate cash flow.
So he might be incentivized to build a cool robot that nobody buys yet, just to show the world, hey, look, we have a robot, which pumps the stock and unlocks his bonus. Even if shareholders would rather he just sell more Model Ys.
That's a risk. The filing is warning you that what's good for the CEO's bonus might not always be what's best for the company's stability. Plus, they reiterate that key man risk. It explicitly states that Elon Musk does not devote his full time to Tesla. It lists SpaceX, Neuralink, Boring Company, and now xAI.
That is a lot of plates to spin, especially when you're trying to pivot a $100 billion company into a completely new sector.
It is. And that brings us to the future. Looking ahead to 2026, we know they're spending $20 billion. We know about the AI. But what about the cars? Is the car business dead?
It doesn't seem dead, just maturing, maybe. They mentioned the refresh of the Model Y and new Model 3 variants were completed in 2025.
Right. They aren't abandoning cars. They mention a next-generation platform, which is likely a cheaper, smaller vehicle. But the language has shifted. They acknowledge the current moment is cyclical and volatile. They're basically saying the car market is tough, so we're maintaining our position while we build the escape hatch into robotics.
And they are building that new mega factory near Houston.
Yes. So they are building capacity. They aren't shrinking the footprint. They're expanding it. But the focus of that expansion is clearly shifting.
So let's try to synthesize all of this, because we've covered a lot. We have a company that made less money in 2025. It's facing higher taxes and tariffs, but it's sitting on a mountain of cash, $44 billion, and pouring it all into robots and supercomputers.
Tesla in 2025 and 2026 is a company in metamorphosis. It's enduring a slump in its core product to fund a sci-fi future. And the bridge between the two is the battery business, which is booming thanks to AI data center demand.
It's a very risky bridge to cross.
It is. If the robots don't arrive on time, Or if robotaxis get regulated out of existence, that $20 billion a year in spending looks very, very reckless. But if they pull it off,
Then they aren't a car company anymore. They're the engine of the global economy.
precisely, they become the utility company for labor and transport.
And that leads me to my final thought for you to chew on. The filing mentions that risk about the CEO Performance Award, that it might incentivize products consumers don't want yet. It makes you wonder, is Tesla investing in the world we live in right now, a world that needs affordable transport and reliable energy? Or is it investing in the world the CEO wants to live in?
A world of Mars colonies and butler bots. That is the multi-billion-dollar question. Are they visionary or are they hallucinating?
I guess we'll have to wait for the 2026 10K to find out.
And in the meantime, I highly encourage everyone, next time you see a headline, actually read the risk factors section. It's where the real story is.
Always read the fine print. Thanks for diving deep with us. We'll see you next time.